In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back to all of our Market Rebels and to Stu. We have joining us for the first time in a few weeks, Scotty. What's going on?
Oh, good to be here, Bill.
All right.
I'm just enjoying this fall weather.
Oh, finally starting to knock out some of the heat here in Florida too, a little bit, but we're still blazing hot. But it's great having you here. I know you've got a busy schedule, and both of these are two of our world-class coaches here at Market Rebellion. So they're going to help us out today with a really interesting topic.
It's a good one.
It is. I love this. But before we do, we had a little turnaround, I think, during the day, didn't we, guys?
We did. We got a couple of green candles out of it. Still down a little bit on the day, except for the Dow, which is actually up a little bit. But, kind of flat, but not down radically.
Different from when we had our afternoon Q&A.
Yeah.
A nice little turnaround.
A lot better, right? Yep. Mm-hmm.
Yeah. So
Apple's dragging the NASDAQ down today.
Yeah. Who would have thought, right? So one of the things that we like to really show here and to highlight on Coach's Corner are just different strategies, different philosophies, different theories, just different ideas to help you make better decisions. And today, that's what we're going to do. Again, I just think this is such a cool idea. So as always, let's start off with our, why didn't we just switch there? There we go. With our Chalk Talk, which for anybody joining us, this is a little thought question, a little challenge question for you, and we will answer it at the end of the presentation here. So here's the question. You bought one $100 call, paid $5 for it, and you sell two 110 calls for $3 each.
Mm-hmm.
This is what's called a ratio spread in the business. And the question is, can you sell this ratio spread safely? So we want you to just think about that for 5 or 10 seconds. You guys can kind of think about it for a moment, even though I know you know the answers. But can you sell that safely?
Yeah, and here's a hint, everyone. Before you answer no, think outside the box. Think outside.
It's a bit of a trick question.
Yeah, I had a feeling you guys knew where I'd be going with this because any professional trader knows that it is a bit of a trick question. So we'll come back to the end and find out what the answer is.
Look for a solution. It's there.
Yeah, look for a solution. Options will usually give that to you.
Yeah.
So what we wanted to present, a little bit of a hint for you here, using ratio spreads safely for leverage. So what prompted this presentation, this Coach's Corner, is that most traders that you talk to will say, in this case, a ratio spread. Oh, I don't want to do the ratio spread because it's too risky. And therefore, let me just cross it off my list, something I don't ever need to learn.
Bill, I know. I haven't seen this entire presentation. I just want to let everybody know that I have not seen the entire presentation, but I know exactly where Bill's going with this. And this is so cool. This is so cool. And if you can get this, not that if you can, when you can, when you think about it, when you kind of think it through and figure out that it all makes sense, this is so cool. Just the way this kind of works out. So go ahead. I love this. This is good.
Yeah. So the idea is that if you're one of these traders that says, oh, I don't need to learn short straddles or short strangles because they're way too risky, I would never do it. Well, they might be risky by themselves, but we might be able to combine it with something else that you're using, which could completely reverse that risk graph.
Hint.
Hint. So we often make the analogy that options are tools. They are tools for adjusting risk. You can shut risk off. You can crank it up in any shade in between. So part of what we're trying to show here is don't avoid a strategy just because the strategy by itself might be risky. We have to say, well, how else could I use this tool? We might be able to combine it with other tools and say, hey, I could actually make use of this. And that's what we're going to do here with our ratio spreads. So let's start off with a little definition here, guys. Ratio spread, as we saw in the chalk talk, we're going to buy one call and you are going to sell two calls at a higher strike. Now we could do the same with puts in the opposite direction. Most of the time, this is going to be a volatility play. Not always, but that's one of the main reasons. One of the main reasons that a lot of traders will use this. And another advantage is that we get wide break-even points, or we will always have at least one break-even point, but we might actually have two, and they're fairly wide. And so this is another thing that's very enticing about it. They'll say, yeah, we've got this unlimited risk on the upside, but look at how wide these break-even points are. So those are some of the reasons that people might entertain the idea of a ratio spread. So let's do an exact example. Let's say that we buy a $100 call. We're going to spend $5, and we are going to sell two of the 110 calls for $3 each. And what that means is we're going to end up with a net credit, right? If we spend $5, but we collect $6, that gives us a net credit of $1. So in the business, we would say we are selling, or we are short, the 100-110 ratio spread for a net credit of $1. All right, so guys, what does our risk graph look like? Let's see this upside unlimited risk. That's what it looks like. And so you can tell that right here at the short strike, the 110 in this example, that's the highest part of the curve. That's the ideal spot.
Bill, can you go back? Can you go back one frame there? One thing, one buy one call, sell a 110 ratio. So I know that people, everybody's got like a different opinion about what they call it. It really doesn't matter. It's just a name. It's just a name. If I were back on my floor days, buying one, selling two, I would actually say I was buying that spread for a net credit.
I know what you're saying. Some people will, because you're buying the lower strike spread, the lower strike. The reason they usually call this a sale is because of the unlimited upside. But I agree with you. Normally, we would always say, what's the more valuable strike, and are we buying it or selling it?
I'm going to do the 1x2 front spread for a $1 credit.
Yeah, right. So, so this is the risk graph. Again, this is why most people will consider it a sale, because we're generating a credit and we have a short position. But take your pick. The point is, this is the risk graph. Here's the ideal spot right here in the middle. But because we got this net credit, we got this little sliver down here that is going to be bare bones minimum no matter how low the stock price goes. But we start running into trouble up here. Now, this upper break even is 121. All right, now how do we figure that out? Well, at 110, we have a maximum gain of 10 plus our dollar credit, or 11. So we can kind of chew through $11 on a delta 1 or delta -1 past 110. So that's going to be break even.
Right, for $10, and then the extra dollar will give you the 121.
121.
And on the left side of that graph, of course, is your $1 credit.
Right. Now, if we had a debit over here, we would have two break evens. We would have a cross break even point down here and one up. But a lot of times traders try to sell off enough of the short strike to shift this at least a little bit above zero. So
Little bit, yeah.
So at least they have something to show for it if it goes
south.
Completely goes south.
Uh-huh.
So the problem that we have here, remember our stock is at 100. That's a big break-even point, 121.
20%. That's a move.
That's a big move. So again, that's part of the lure. Even if it comes unraveled, we at least get something out of the deal. But here's the big problem. This unlimited risk to the upside. And that's where a lot of traders look at this and say, I would never, ever touch this thing, so I don't need to know anything else about it. Let's just eliminate it from our toolbox. And one of the main themes of today's presentation is that's a really bad idea. You need to look at this and say, all right, here's the characteristics of this tool. How could I use this tool in combination with other tools to where maybe it is something that I can use?
Right.
And that's what we're going to look at here. So before we do, as always, for anybody who's new, please check out marketrebellion.com/get started. Got a lot of great free tutorials, videos, all kinds of things to help you get started with your options and trading. So check that out. So let's take a look at.
I got to do something here. So let's make pretend that this is a hammer. There's a hammer, and here's a nail. Well, I can't really get the nail into the wall without the hammer, and the hammer without the nail doesn't really get the job done. But if I put them together, now I can really do something, can't I?
Now, right. They're two different tools. And you might say, I have no need for a nail and I have no need for a hammer. But suddenly you find out, hey, I got to hang a picture. And these are two tools that I can use. And that's kind of what we're trying to show you here. Don't run away from what appear to be risky strategies just because by themselves they look risky. So here's one thing we can do. And I know
which they are, which it could be, which it is.
Sure, it absolutely could be. Right.
Yeah.
But let's take a look at this. What if we combine it with shares of stock? All right. So the ratio spread that we just showed you leaves you short 100 deltas. And that's because we're long a call, but we're short 2 calls. So on a net basis, we're -1 on the upside. So we have short 100 deltas. All right. Well, that might be what your fear was all about, that we have this unlimited upside risk. How could we combat that? Maybe buy 100 shares. There's now long 100 deltas. And so in the extreme, at the far right side of the graph, we will have 0 deltas.
0 net contracts.
Yeah, we were talking about that today, net contract exposure. Now, what about to the downside? Well, the downside we saw even in isolation that the ratio spread had 0. But now we're introducing the 100 deltas to the downside. So here's where it can really be a big trading tool for people who are looking for additional leverage but don't want to pay for the trade. So let's say that I'm going to use an actual example, Stu. We're going to look at Nvidia. And at the time I did these, the stock was pushing real close to 500. Hard to believe. And the 60-day options, I'm rounding within a few pennies just to round them, but these were the actual prices. 60-day $500 call was about 32, and the 540 calls were 16. And what you're trying to do here, at least for this strategy, is you're going to look at the cost of one, usually the at the money, doesn't have to be, but we'll find the cost, and we're just going to look down the broker's platform to find one that's about half price. And you will eventually hit it. Now, it might not be 40 points away. In some stocks and some expirations, it might be 5 points away. It might be 60 points away. But you just keep looking down till you get roughly the halfway point. So in this example, we would say we are selling the 500-540 ratio spread for a net 0.
Right. Okay. Or you could go a little bit closer and maybe do a little bit of a credit, like maybe the 35s or the 37s or
sure.
The 30s, and there'd be a little bit of a credit.
Yep. But even if you try to do this 50% level, in the real world, you're probably going to be at a very slight credit or a very slight debit. But that's the idea. We're just trying to get it close to 0. And the reason we're trying to do this is so that we don't have any out-of-pocket expense. Now, as we're going to find out, that doesn't mean it's free. But at least there's no out-of-pocket expense. So where this strategy really shines is somebody who usually owns the shares or is willing to own the shares. So let's say that you wanted to buy, or maybe you already have 100 shares of Nvidia. All right, so you've already got that in your account. Here's your risk graph. There's the break-even point at 0 because that's the current price of the stock. We have unlimited downside, unlimited upside, dollar for dollar, straight line. And we'd like to get 200 shares.
So look, and everybody listen, that's different than, hey, I want to do the 1-by-2 ratio and I'm going to go out and buy 100 shares to hedge it. That's not what we're talking about.
Exactly. Nope. We are assuming
you already have 100 shares lying around, and now you can add to it. And what do you got?
Correct. So that's what we really want to show. So this is for somebody who already has the shares, was already willing to assume the downside risk, which was proven by the fact that they already had the shares in their account.
Yeah.
So what's going to happen here? Well, this is 100 deltas all the way through. 100 shares, dollar for dollar up, dollar for dollar down. Now, if we look at that ratio spread that we just showed you, the 500, 540, by itself, it would look like this. That's what we saw before. But remember, this is not what we're doing. We're combining these. So if we take the black curve plus the red, what do you suppose happens to our risk graph here?
You take it, Scotty. What happens to that line? It goes...
Plateaus.
What?
Flattens out.
Yeah, absolutely.
Yeah, and we can actually see it here graphically because that's a 45-degree line or 100 deltas up, and we've got a 45-degree line or 100 deltas down here. So they're going to cancel each other. And that's another way of understanding that they will flatten.
And that's what zero contract exposure means.
That's what zero contract exposure means on the upside.
They just flatten out, right? All the deltas become 100 and everything nets out, and you're long and you're short, and that's it. It's over.
So once we put both of these in our account, so just want to make this very clear. We have 100 shares, that's the black line, and we have sold this ratio spread. And on a net basis, this is what we look like. So here's the old position in black, kind of faded it out there. So you can see that we still have the 100 deltas to the downside. But
which we would have had anyway.
We would have had anyway, right? We have not increased our downside risk. What we've done, the reason for doing this, is to bump this up to 200 deltas. But we didn't spend any money out of pocket. Now, there's another big benefit here. We got what's called a crossover point, which is different from a break even. It's really an indifference point, where in this case, the stock trader on the black line would have the same profits as the trader in red. Mm-hmm. And that happens to be right here at 580.
Which is a long way up.
It's a long. Now, how do we get the 580 number there? You guys want to explain that? How do we get how could people kind of figure this out?
You want to take it, Scotty?
Well, you've accelerated that profit curve. You've widened your zone of profit. So now you have a wider target zone of profit. And because you've interjected the options, which are, have gamma, you've accelerated the
exactly.
The P&L.
Yep. We're going to accelerate those. We would have had to get, if we own just the stock.
Yeah, you've limited your upside, right? That's the trade-off. But that trade-off is limiting, maybe an unlimited gain. The last time I saw an unlimited gain come to my mailbox was, we don't see this too often. If you had a target of 570, 580,
sure,
550, 560 on the stock, you've not had to purchase more shares of the stock.
Right.
Now you've accelerated your potential profit.
Yep.
And you've limited your upside, right?
And the math is super easy, guys. Like
academical.
When you think about it, everyone out there, when you think about this, what do you got? If you got 200 shares and you're running from 500 to 540, that's 40 points. 2 times 40 is 580. That's how you get to the 580, super quick like that. And if you're willing to give up that 580 and up, this is perfect because you're gaining an extra 100 shares on the way up that you wouldn't have had before for
no
nothing.
Out of pocket. Right.
So take a look. Literally zero.
Right. So the person that did the ratio spread on top of the shares will get the identical profit at a stock price of 540 instead of 580 because we now have 200 shares times 40. So we reach that same 80 profit level, which is 7% lower. Now, that might not seem like a big deal, but remember that most stocks don't move 7-8% in a year. This is a 60-day trade.
Yeah. Here's another way to look at it. What's going to come first, 540 or 580?
Absolutely. Right.
Yeah.
So even if you think, and remember, the market doesn't care what you think, but even if you think that stock is going to 580, it's going to go to 540 before. So if you're right about 580, then you are definitely right about 540. But what are the two key words we tell everybody to ask? What if? What if it doesn't get to 580?
Mm-hmm.
No, you're still going to be better off, because we can see that the red line sits above the black line for this range between 500 and 580. That's where we've got the accelerated deltas.
And again, keep in mind, this is for somebody that already has 100 shares lying around. Right. It doesn't have to be 100 shares. I mean, it's just the ratio. And look, truth be told, you can also substitute like an in-the-money call in there in lieu of the for people that are doing the stock replacement.
Yep.
Yeah, all kinds of things, and then that left side of that tail doesn't go down forever. It kind of flattens off at some point way down there. But hey, at least that's a piece of a hedge as well.
Absolutely. Yeah. Once you just understand the basic idea of what we're talking about here, it opens up the doors to dozens of variations of this, dozens and dozens. But Scotty, now you were talking about, because I wanted to address this. I said there was no out-of-pocket expense. But as we all know, nothing is ever for free. So as Stu pointed out, we have not increased our downside risk. It's still 100 deltas. We spent 0 to put this position on. So where's the cost?
In the margin requirement on your credit.
That could be part of it. But what about over here? What about
the risk? The risk is to the upside if the stock exceeds your target there. If you're 580, if you're 580 is your short strike plus your credit, you exceed that. Yes, your risk is the stock makes a big gap up. There's some catalyst. The stock shoots to the moon and exceeds your crossover at 580. That's where the risk is.
Yeah.
Well, yes, I might have misspoken. I think you're talking about just the ratio by itself. I'm talking about this red line right here. The cost is that we are giving up this.
See, people think about
opportunity cost.
That's exactly what it is.
I see. Yeah.
It's an opportunity cost.
It's an opportunity
which is different than risk out of pocket.
Yeah, and you're going,
maybe it kind of depends on how you look at it, but it's not going to be money actually out of your pocket as if it does this, I'm going to lose. You're not going to lose. You're just not going to make over 580.
Yeah. How realistic is that opportunity cost?
Exactly. You have to say really what you're giving up is not very realistic. And a lot of traders, especially short-term traders, are probably not looking to hold between 500 and 580. A lot of the ones we know, Stu, are going to be out at 503, or 510 or 520. Well, you might as well get 200 deltas for it.
Right. And you can also put it on a distribution curve and see what the standard deviations are from the straddle and see what your probabilities are up there. You'll be astounded what the low probability of 580 is going to be, 30 days out, 15 days out. In fact, while you guys are talking, I'm going to look at it. 30 days out, $80 up.
Just to comment on that as well, if that were true, maybe we could buy the 520 and sell the 560. I'm sorry, the 520 and the what have we got here? We did 40 points up. Yeah, you could do like a 520, 560 or a 530, 570. You can always shift this higher.
So just for kicks, look, I just took a look at the money straddle right now. $80 up is 2 standard deviations.
Oh yeah,
2 standard deviations, which is a 13% probability. So if you're not, if you're not willing to give up anything over 580 in this example on a whim that there's a 13% chance, or maybe even a little lower depending on where you are in the second standard deviation, you got to kind of think twice about what your goals really are.
Exactly. I tell people that all the time. Is that really a realistic goal? So back to this idea here. Yes, there is a cost. It's not an out-of-pocket cost, and it's not an increase in risk cost. Because if you had purchased the shares or an additional 100 shares, your risk graph would be coming down here. You'd have 200 deltas to the downside. So if you were willing to assume 100 deltas of risk, we didn't change that. We didn't ask for more money out of pocket. And yet now you've got twice as many deltas. It's a really cool use of a short ratio spread, a strategy that most people would never consider. And by just simply owning the stock, it radically changes the uses. So, yep, I like that one. Now let's take a look at something else. You brought up a good point about this, Stu. I know we had some email and text exchanges. Let's say that our stock is 500 and the 60-day 500 call is 32. That's what we just looked at. And we looked at selling the 540 call. What else could we do? Well, maybe don't sell the 540, but bring it in a little bit to the 520. Now, the 520, we know that lower strike calls have to be worth more money. They give you the right to pay less. So it's going to be trading, let's say, for 23 instead of 16. Again, these were real prices.
Here's where everybody's head should be going. Oh my God, now I'm going to get a credit for it. Now I got money, even if the whole thing fails and falls out of bed, look, I'm still going to make some money because I got money coming in, money out. Just follow the money.
We could also just hold that credit as a little bit of a downside hedge. But what else could we do with it? What else could we do with a credit if we were worried about that downside hedge?
How about picking up a tail on the left side by buying a put?
Yep.
Using that money to buy the put and then lift that tail on the left so you don't have unlimited downside.
Yep. So in this case, we have sold the 500, 520. That's buying this one, selling this one. Net credit of 14. That's just the difference between the 32 and the 23.
Yeah.
And we're going to buy, it just turned out, again, these were live prices at the time, the 470 put for 14. Now what happens to our risk graph? All right, this is what we saw before. What happens now over here to the left side with a long put?
Go ahead, man.
Flattens out.
It's going to flatten out. That's your insurance policy.
We've narrowed the strikes. So remember, the narrower the strikes, the less aggressive your outcome. And so we have less risk. We will also lower our potential reward because narrowing those strikes gives us a greater credit.
Excellent.
So
that's right.
So we've moderated our risk, our reward at the same time.
Right, which is always going to be true. And one of the things that we liked about this is that if you are not, the other trader would have been considered more aggressive, looking for it to go to 540. But what we're saying here is, all right, what if I'm not? Well, if you're not more aggressive, it probably means you're also a little more risk averse. So what we could do is go from this red curve to now this. There was the old curve, and look at that. See, we used to have these 100 deltas to the downside in black or in red, but now by buying that put at 470, which is 30 points lower, still a pretty good hit, but it's not unlimited. And what have we done? We've reduced the profit, as Scotty just talked about. That's part of the cost, but the benefit is we've decreased the amount we could lose, increased our insurance policy.
This kind of looks like a vertical spread, Bill.
Looks a little bit like a vertical spread with a little.
That's a hint to learn your synthetics, everyone.
Yeah, I thought about the same thing too. Yep. So anyway, those again, it just opens up an endless list of possibilities just by understanding one strategy that you thought otherwise was something you had no interest in whatsoever.
Right.
But hold on a second, because it's going to get even better. And we're going to talk about that next. So also remember, for anybody who's new, marketrebellion.com/get started. Be very careful where you get your coaching materials from and training materials. A lot of bad info out there.
A lot of bad info. Yeah.
In fact, we were just talking about one the other day, weren't we, Stu, on a website? We said we might have to, without giving out the website, show the comment that this guy made that was just dead wrong.
Yeah, he was 100% dead wrong.
100% wrong. Yep.
Yeah.
So, but anyway, you have to be very careful, and we want to make real sure that everybody learns the right way. So check that out if you're looking for some good information. So Bill, now here's a.
Sorry, I was going to make one other comment, which we didn't talk. We talked a little bit about volatility, right? The ratio spreads is a negative Vegas strategy. So this can be applied. This approach can be applied if you own a high beta stock that has very elevated options, inflated options.
Excellent.
And your expectation, maybe the stock price is already baked in some, shot to the moon movement.
Right. Exactly.
And so you could take, because the heart of that is selling those two options.
That's right.
And if you're looking, you have a high beta stock like Nvidia, selling those two options is a great way to capture that credit, widen out your profitability zone, and take advantage of a volatility contraction.
Absolutely.
So that's also a great, in addition to moderating our risk, just playing that volatility is also, can be done through the ratio spread.
Absolutely true. And that, again, shows now we've opened an entirely different door talking about volatility. When I said there were dozens of strategies, it was just talking about stock and the ratio spread. But now if you want to interject, start bringing in gamma or vega or other things, that's a whole nother discussion. And that's what makes options so fascinating and so powerful. Case in point, we can take that same ratio spread that everybody would say, oh, no, I don't want to learn it because it's too risky. There's another strategy that's more for the defensive, or when things have gone wrong, let's call it, called a stock repair strategy. And I know both of you know this, and I think all three of us are in agreement. We're not wild about the name.
That's an understatement, Phil.
It's an understatement, but it's what the industry knows it by. The reason we don't like it is because there is no such thing as a repair strategy where you can push the button and get your money back. That would be a repair strategy.
Hey, I lost 10 grand in a trade the other day. Can you get it back for me?
Yeah, just do the stock repair and there's your money back. That's how people think that it works.
Yeah.
But it's still a pretty cool idea for the right premise. And so here it is. We've got our stock at 500, and let's say that it falls to 450. We've never seen a $500 stock fall 50 points before, have we?
Nah.
Never. All right. And this can happen quickly. Now, I know most people say I'd never let that happen to me. Not true. That stock could gap down 50 points. It could halt intraday. You cannot stop it. If it really wants to get there, it's going to get there. And another thing is that people usually say, it's going to come back tomorrow. It's going to come back tomorrow. And they just keep holding it lower and lower.
470 becomes 460, 460 becomes 450, 450 becomes 400. And
now I might as well hold it, or now I might as well buy some more shares. And now they've accelerated the downside.
Yeah, now you got a hole in your hand because the knife just went through.
It went right through it. So let's take a look at this. The 300 call at this time was about 202, again, rounding within pennies. The 300 call and the 400 call was 103. Now, again, I was trying to find something roughly at a 50%. So we could sell the 300-400 ratio for a net credit of 4. Now, what we're going to do here, very important, if you're going to do the stock repair strategy, you must still be bullish.
Yeah, that's
a lot of people say, oh, I think the stock is coming unhinged. Let me do the stock repair. Bad idea, because you still have the downside risk. What the stock repair strategy does is it says, this is more the philosophy. I just wish I had never been in this trade. If I could just get my money back, I'd be willing to walk. It's more of I'm just hoping to get back to even. And in order to do that, I'm totally fine giving up all of the potential upside. I just really want to recoup my money. Well, if we do that, we have to wait, in this case, for the stock to go from 450 to 500. What could we do here? It's exactly the same strategy. Instead of using it aggressively on the high side, we're using it on the loss side. Uh-huh. So we can see it's exactly the same risk graph. But now take a look at this break-even point. All right, we had a 4-point credit. So if we come 4 points off of here, we have a break-even at 396. Now that is 21% below the 500 price that you would need to get back to break-even.
Yeah, and again, guys, it's because of that extra 100 deltas.
Yeah. So, yeah, right. You can see that right here. It's accelerating you to the break-even point sooner. Now, we can also see that we don't have much profit to speak of, maybe $4 in this example. In some cases, you might even be slightly underwater. You might say the best I can do is a $5 loss. Well, it's still better than having to wait all the way up here. It's a way of accelerating your deltas for no out-of-pocket expense and no additional risk that you didn't already have.
Yeah, but be careful with this, everyone, because I've seen people try this, and and then the stock goes back to 500 or 550, and you're like, oh, what did I do? Just be careful.
Right. You have to have a set of goals. You have to have the right perspective, and just realize what this is it's just trying to get your money back and get out of the trade. And that means we are giving up all of this. Right? Now, what if we thought, gee, I get this feeling that Murphy's Law is going to kick in and I could see the stock running to 570. What could you do there? Buy the 570 call, lift this side of it up.
Accelerate your delta.
Roll it up.
And accelerate your deltas from zero. So there's all kinds of ways that you can mold these risk graphs. But the main thing that we wanted to share with everybody, I think this is a really good example. We're taking a strategy that most traders would say, I want nothing to do with it because it has unlimited risk. It's super risky, high margin requirements. Well, that could be true by itself. But when we combine it with something else, and as Stu said, what about a stock replacement call? What about, there's all kinds of things we can combine this with. But we know there's a lot of stock traders out there who are in this type of a situation. I'd love to have 200 shares. I don't know if I want 200 shares of risk to the downside, and maybe I don't even have the money for 200 shares. Here's a beautiful way that options solve the problem by giving you an extra 100 deltas for no out-of-pocket expense and no additional risk. The trade-off is all up here to the upside. So any final comments on this graph, guys?
I think it's an excellent idea. I mean, I kind of love the idea here. If I can, if you can come to terms, if you can come to grips with the idea that you're willing to give up some upside in order to accelerate your break even, this is a great idea. But again, It's premised on the idea that you are willing to accept that downside in the very, very beginning, which is proven by the fact that you're a stock owner.
That you are already stock owner.
You're not going to go out and do the 1x2 and then go ahead and hedge it with additional 100 shares of stock.
Whole different thing.
That's a whole different thing because now you're creating that downside, which you did not have before. And that's it's night and day.
And that's actually another good point, Stu. You could look at this and say, trader A had the shares of stock in black and then did the 1x-2. And trader B had the 1x-2 and then bought the shares and say, well, they're doing exactly the same thing. And that might not be true. The other second trader might not really be all that comfortable with the downside risk.
Yeah.
So even though they end up with the same positions, doesn't mean it's good for both of them.
Right. So know your goals and know your risk. That's all.
Know your risk. Yeah. We've heard that one before, haven't we?
Yeah, we have.
Okay. Any closing comments on this slide here, Scotty?
Oh, I was just going to say, if your stock is pulled back in this case and you want to repair, accelerate back to gains or claw back to break even, you might do it on a stock where the downside is less likely, right? Where your level of certainty, maybe the stock's at a technical low point or stock fundamentally is deeply oversold. And so you have this higher level of confidence the stock will truly come off the bottom. Then that would be, more appropriate. And again, that's always hard, but if your analysis is providing some higher level of certainty, this would be fabulous. I've seen this. I've done this myself. It's great strategy.
Yeah, that's a great point, Scott. Excellent point. Yep.
100% agree. With all of that, we hope you, everybody out there in YouTube land, learned something, and all of our market rebels. So let's come back to our Chalk Talk question. So you bought $100 call for 5. You sold 2 of the 110s for 3, or 3 each, which would be a 1x. Technically, we should call it a 1x-2 to highlight the fact that we are short that. So what was the question? Can you sell the ratio spread safely? And what's the most common answer that we give people to any options question? It depends.
No. Maybe.
It depends.
Yeah.
It depends. Now, what Scotty was looking at here, can you sell this safely by itself? The answer is no. And that's how I would, if somebody walked up to me and said, can this be sold safely? I would say, well, by itself, you've got unlimited upside risk. So I would say no. However, if you've already got the stock, then the answer is yes. So do you see how the answer can change depending on the person that you're talking to and what they're trying to do with it? So that was more just to make people think in isolation, yes, this is considered a very risky strategy. But if you think that gives you the right or the excuse to say, I don't need to learn it, we just think that's a bad idea. And we hope that this showed you some of the reasons why. So any closing comments there? Scotty, Stu?
I think this was great, Bill. I it's been a long time since, I've visited ratio spreads. Can be very valuable for these.
Yeah, they can. They
highly inflated stocks, biotech stocks, or some potential catalyst. But you know, it's good to go over this with long stock, and especially high price stocks like, you know, $500 stocks.
That's why I chose.
You want to kind of claw back your losses, and buying 100 shares is very expensive. This is a beautiful. I mean,
and you've now accelerated your downside risk if you're wrong. You know, now you've got 200 deltas to the downside if you did end up buying more shares.
Exactly.
So this is another area where options can just really come to the rescue if you know your options. Stu, any last thoughts?
You know, Scotty's commentary here about the Vega part, you know, we really didn't really talk about that much, but it is absolutely on point. You know, Vega is one of the risks which many times is often overlooked, and it can't be. It is so incredibly powerful. I know from personal experience on both sides of it. It's a very, very powerful Greek that we absolutely have to pay attention to. The risks and the opportunity are tremendous. And if you're in an environment where you might be long some Vega, or the opportunity is there for you to take advantage of some sort of reversion back towards the mean, absolutely have to consider this kind of this strategy. Oftentimes, in the bigger picture, in the more macro picture, Vega is often used as a hedge against delta, and you can absolutely incorporate this concept into that to mitigate your risk, to lower your risk on a position. So, yeah, really good.
So know your risk, but more importantly, know your options. So if anybody's out there looking for coaching, we do. In fact, we've got two of them right here to present to you, Stu and Scotty. Certainly check out marketrebellion.com/get started, because we'd really like to see everybody learn options the right way. So with that, I want to thank all of you for being here. We have another really cool topic. I'm not going to even release it, Stu, but we got another really cool topic for next week, and we'll look for you next Thursday. We'll see you then. Thanks so much, Scotty, for joining us today.
Yeah, thanks for having me, Bill.
Of course. Thank you. We'll see you then.
You guys.